Good afternoon and welcome to the Spring 2022 Linneman Associates Capital Markets webinar presented by Linneman Associates and Real Estate Financial Modeling. This is your host, Bruce Kirsch, founder and CEO of REFM, provider of financial analysis tools and training to the business since 2009. Today, we're pleased to have an insightful program for you, which will be presented by Dr. Peter Linneman, founder of Linneman Associates, which, for those of you who do not know, is a strategic and investment analysis advisory firm. We're using the GoToWebinar platform, and I would like to address a couple of housekeeping items before we get started, just to make sure everyone's comfortable. On the audio front, all of the participant audio is muted, meaning we cannot hear you as a participant, and that's by design and will remain the case throughout the entire webinar. If you're attending by computer, please take just a moment now to familiarize or reacquaint yourself with the control panel elements. We will be showing the slides, but if you would like to download them, you can find the handouts section of the control panel and click on the file name and it will download. You don't need to have the slides up because we will be showing them, but you're certainly welcome to keep them for future reference. As always, we've reserved 15 to 20 minutes at the end of the webinar to answer participant questions, but feel free to submit your questions at any time during the presentation by clicking in the questions field of the control panel, typing the question in, and make sure you click the send button. If at any point during the webinar you get disconnected, simply reconnect the same way you did originally. If you are registered, you will automatically receive an email link to the recording of the webinar about an hour after we finish today. And without any further ado, I'd like to introduce the presenter, Dr. Peter Linneman, CEO of Linneman Associates. Peter, happy spring to you, and we're excited to hear what you have to say today.
Well, it's great to be here, and thank you very much. I'm speaking from a gorgeous Philadelphia, and it's windy, but fall has arrived. Bruce, I have a small technical issue. So what I'm going to ask you to do is if you would tell me what each slide is. I know what they are, but I'm having a hard time pulling it up technically here. So we'll walk through some slides and then do Q&A. So I believe our first slide is COVID. Is that correct, Bruce, as I recall?
That's correct.
Great. So the reason I put deaths up here is it is the most, consistent metric of how we are in terms of the great disruptor of the last recovery, which was COVID, obviously, and it's down. We're basically at an all-time low. Cases have come to mean less and less. Cases always had a bit of ambivalence, and as we went through Omicron, cases sort of lost all meanings. There's a couple of firms that I follow who follow the number of their employees who are out because of COVID or COVID complications, and it would show a very similar picture, which is we are at essentially the lowest we've been since this all began, and that's obviously a great indicator for the economy as we look forward. Bruce, what's our next slide?
Real GDP.
Yep, I have these in my memory, but I don't want to get people confused. So real GDP. The remarkable news is that the U.S. economy is about 3% larger in real terms than when all this began. And if you think about all the things that have happened since this began, to have an economy that's grown 3% over the 2 years is a pretty staggering phenomena, and not to easily be forgotten. And the reason I point that out is that if I'd have told you we'd have had deaths and sicknesses and shutdowns and travel disruptions and contentious election and civil unrest, and just go through it all, we're 3% larger. And you can see on this chart in the blue how precipitous the drop was. and that the recovery has been pretty steady upward. The blue has been pretty steady upward. The red is an estimate or a guesstimate of if we'd have grown at 2.5% a year, where we'd be today. So we're up about 3%, but we're around 2% lower than where we would have. That's important because it says this is not an overheated economy. If in fact the blue was way above the red, you'd say, wow, this is an overheated economy. We've grown way, not only did we recover, we've grown way beyond normal growth. We haven't. We've grown less than normal growth. And that simply says that anything you're seeing in the economy is not due to overheated demand. It is due to other things, but it can't be due to overheated demand, because if it was due to overheated demand, the blue line would be above the red line, and you can see it's obviously not. With that, it also says we have room to grow on. We have runway. We have distance to catch up. So I view this as one of the great strengths of the economy at this point. Go to the next slide, Bruce. I've got my tech working at this point, and it's private sector and employment. And the reason I'm focusing on private sector is it's the productive sector of the economy. It's what drives the economy. And you see in the red line where we were when it all started. We're almost back. And in fact, I think since we did these slides, we had just gotten the other day the employment report, where last month was a 400,000 job growth. And so we're basically exactly where we were before all this began. However, the green line shows if we'd have continued to add jobs at sort of a normal rate, we'd be about 3% higher than we are, consistent basically with the real GDP story. That is that we are recovered, but not fully recovered. Again, great potential. I will also mention two things on this chart. Ever since we hit bottom, and you see back in April, May of 2020, all people have said is people are not going to come back to work. Every month, people have said they're not going to come back to work. They've found a new way to live. They have rediscovered all that nonsense. Look at the blue line. They just keep coming back to work. And they come back to work for the reason they were working before all this. They want cars, they want vacations, they want homes, they want to put their kids through school, all those things. So don't be fooled by this nonsense of they're not going to come back to work. Look at the data. And the data is quite striking. But labor always lags real GDP during a recovery, and this has been no different. Second thing, the real GDP number you may have seen for the first quarter was negative, not on my chart, but you've got a lot of headlines that real GDP shrunk in the first quarter. That can't be true, or at least it can't be true the economy's shrinking. And why? Because you can't add 400,000 jobs each month during a quarter and have a shrinking economy. You can't have industrial output going up 3% in the quarter and having a shrinking economy. And if you look closely at the GDP numbers for the first quarter, it was all about the net import-export sector, which has a lot of technical adjustments going on. But the reality is, in the first quarter, the economy grew. And if you don't believe it, just look at the jobs and look at industrial output. Go to the next chart. Also consistent with the notion that the economy really grew in the first quarter and through April is weekly unemployment insurance claims. And this is a staggering chart in that we've got it. You see all these earlier recessions, which were terrible. I lived through all of these recessions. All those little peaks were not little peaks. They were big problems. People went on unemployment like mad. And then you see what we just went through makes you rescale everything. Now, the good news is unemployment insurance claims are back down to normal. Little nuance, and by the way, you could not have this low unemployment insurance claims if the economy had shrunk in the first quarter. It just would be literally impossible. So that is showing much better strength than that GDP number would have. And that's why you've got to cross-analyze the data as you go. Second thing is, if you have a real good eye, you'll notice sort of in late 2021, mid to late 2021, this flat line for a while, up at about 600, 700,000 a week. And people were saying, see, we told you these people are never going to come back to work. Yes, there are job openings. They're not going to come back to work. And then September 8th last year, the federal unemployment insurance top-up ended. And look what happened. It just plunged so that we're at basically record low unemployment claims. That is to say, stop paying people more not to work than to work, and they go to work. Go to the next chart. You see unemployment rates for teens in red with their average, and everybody in the blue with their average. Teens way below, and that's an indicator of extreme strength. If you're hiring lots of 16 to 19-year-olds, that only happens in really strong economies. So you get a sense of how strong it is by how low that is. And the blue is everybody, and the unemployment rate for everybody is also quite low. So all that's strong. Go to the next. Is what I do is an apples to apple employment. So think of this as employment. And the apples to apple is keeping a labor force at a size equivalent of what it would have been and what it would have grown to. So in 2020, we had 5.8 million unemployed out of 166 million. That's a 3.5% unemployment rate. We're running, this just fell slightly, but we're at a 3.8% today, officially. But we only have 157 million employed. So that is to say we have roughly, we haven't quite total got back to the same employment. So if you say we have 157 million employed, now by the way, just for what it's worth, that should be 400,000 because the data just came out after we updated this. So it's 158.1. So, and you adjusted the labor force for what it would have normally grown for, we've got slack in our labor market. Still a lot, probably like 7.7% slack. Clearly a lot of room to grow. Go to the next, is what I said. You see the people receiving unemployment insurance as a percent of the labor force. You see how extreme it was. I mean, we had basically 25% of the labor force collecting unemployment 2 years ago. And then you see it's gotten down to where basically no one is receiving unemployment. And that's because it's a very strong economy. Let's go real quickly, talk about the US government, all the budgets. And this is more of a cheat sheet for thinking about government spending. Every $1 trillion of new debt by the federal government is about 0.8% of US household wealth. And it's about 0.1% of the net present value of US GDP. The annual interest cost runs, when you do the blend of long and short, let's call it 10 billion a year per trillion. And by the way, call it 20 billion. It's still very small percent of GDP, and it's a very small percent of what the federal budget was before all this began. That's why I take 2019. Therefore, the question is never can we afford it, because obviously we can afford to do it. It's a little like, can you afford to have free coffee at lunch. Of course you can afford to have free coffee. Are you going to get your value for your money by doing it? And that is always the question. And you cannot answer that question about, quote, government spending. You have to answer it about each and every program separately, because some you may get your money's worth on. We probably certainly got our money's worth on the COVID, Operation Warp Speed, and keeping hospitals open and so forth. We clearly got our money. Was it perfect? No, there was waste, fraud, and abuse, but we got our money's worth. On the other hand, lots of government spending, we just don't get our money's worth. So get out of the habit of saying government spending is good or bad. It's no more good or bad government spending than it's good or bad investing. Is it a good investment? Not just is it investment. Go to the next, consumer confidence. It's still above average. You see it circled out there. It's rebounded from when it got crushed during COVID, but it's come down, and there's a lot of uncertainty and a lot of what's going on in, I think, the markets. It's a lot of what's going on with businesses. It's a lot of what's going on with individuals. There's been a rise in uncertainty. Whether that rise is, I thought Amazon was making a lot of money with their online sales and they announced they didn't, or I thought Netflix was going to grow to the sky and they haven't, or I thought the Ukraine war might be over by now, or I think it could get worse because if it escalates, and food prices. So what we have is all the normal uncertainty of life, plus a lot more. And uncertainty is showing in reduced confidence. On the other hand, you don't have that kind of confidence when the economy is shrinking. And it goes back to my first quarter GDP number is not a true reflection of what was happening in the economy. Go to the next, housing starts and auto sales. And I've normalized them to 100 so I can put them on the same chart. And you can see that basically from 76 to 2006, they were more or less coincident and highly volatile. And then they both fell, 2007, 8, 9. And the difference was auto recovered and had fully recovered by about 2015. And single family had not gotten close to getting back to the same line as auto. And you see that single family is powered forward. Auto is down. And the reason auto is down is not because there isn't demand, but there aren't chips. And since there aren't chips, there is just a supply shortfall. And that supply shortfall is indicative of what's happening all over the economy. Namely, we know there's demand. How do we know there's demand? Real GDP is up 3% over 2 years. But we know there are shortfalls in supply. And those shortfalls are both keeping the economy damped and causing inflation. And we'll come back to that. Single family remains strong. Go to the next slide. And single family ownership had started 2000, more or less supply and demand were equal. From 2002 to 2006, home ownership boomed, single family construction boomed, as no down payment was required. By the end of 2006, you started then seeing home ownership plunge because people had to put down payments again. The zero interest rate constrained intergenerational transfers because grandma was getting no income on her CDs and bank accounts, as well as the fact that people were having relatively low savings rates. And suddenly home ownership and single family got fueled. You saw it in the previous slide by surging home ownership due to involuntary savings. You got a refund on your vacation, You couldn't go out to dinner, etc. And in about 7 months, people saved as much as they would have in 6 or 7 years, and they put that to down payments. The other was early COVID deaths created at least 400,000 households, maybe more, who suddenly had down payment capacity. And just think of somebody 74 who was going to live to 84. They died of COVID in June of 2020. And it was very sad, but by about January 2021, people got an inheritance check that allowed them to make a down payment. And so as savings are normalizing, which is definitely occurring, we're back down to pretty normal savings rate as people can travel and consume normally as COVID deaths have gone down. And as COVID deaths have gone down, you're seeing these unexpected early deaths going away and the early inheritance is going away. So as those sources of down payment normalize, you're going to see single family normalize. Now, an offsetting phenomena is as interest rates go higher, that is above zero, which they were for most of the 2010s, the short-term rate, grandma has income on her CDs and can transfer money to the grandkids to help them come up with the down payment. So I think you're going to see still a solid single family, but the surge part is gone. Go to the next. Let's look real quick at the corporate sector. Corporate profits adjusted for inflation, real, are high and flat, which is to say they're keeping up with inflation. And you can see how much of that is being distributed. That is fully recovered. Go to the next chart is industrial production index. This is physical output indexed, if you will. And we put the marker to where it was actually back at its previous high, which was October 19th of 2019. And you see how precipitously it dropped, and it has recovered. However, it started at 103. It's at 103. It was at 100 a quarter ago. So it's risen 3% in the last quarter. Back to that first quarter couldn't be as weak as the GDP numbers show. So essentially, industrial output is flat versus pre-pandemic. Labor is flat since pre-pandemic. So you can think of those as supply of services, supply of labor, and supply of goods. They're flat, and real GDP is up 3%. That is to say, demand is up 3%. Well, if I told you demand's up 3% and supply is flat, and by the way, supply had lagged demand all the way through, you're going to see all over the economy prices rising. But it's not rising because of how much money is in the economy. And it's not rising because the economy is overheated. The economy has only grown 3% rather than 5 to 6%. It's an underheated economy where demand systematically across the economy has recovered faster than supply that has created the inflation. We could have had no inflation if supply had rebounded the way it had and GDP was flat. We'd have no notable inflation. Would we be better off? Of course not. We'd have a smaller pie by 3%. So I think people are really confused about what's going on. Go to the next chart. It's real, adjusted for inflation, average net worth per household relative to a geometric trend. And you can see it's pretty high. And I think it will get higher. I don't mean tomorrow, I mean in general, because these things tend to run for a while. And in fact, there's a lot of money in this system. Go to the next, give you a reminder. This goes back to 1954, and you see the short rate in blue. And in fact, if you look from 2008 to 2017, you see in the blue the truly zero short-term interest rate policy of the Fed that I told you about, which was robbing grandma of her income, uniquely in history, and that's why we had a uniquely weak single-family market. You see that has risen, and in fact, the rate will continue to rise. And then you see the red, the 10-year. At basically a 10-year of 3%, and the short rate's going to go to 2.5%, maybe even to 3%. The long rate will go to 3.5%. That's still a low interest rate environment. Basically, you've lived in that environment. Another way of saying it, as recently as 2019, you can see where interest rates were on both the short and the long, and I think that's about where we're headed, is pretty much what you see in 2019. And you considered it, rightly so, a relatively low inflation era. And you lived very nicely, and asset prices were maintained very nicely by that environment. Go to the next, bank reserves. You can see this is money that banks have the capacity they could lend. They went from zero. QE1 took it up to $1 trillion. QE2 took it up to $1.6 trillion. QE3 took it up to $2.6 trillion. It slowly ran off $1 trillion of excess as banks aggressively lent from late 14 through 2000, early 20. And then as COVID happened, QE infinity set in, and the Fed injected about $2.5 trillion more. That's a lot of money. And it will, I believe, support asset price inflation over the next 5 or 6 years as that replay from the peak from 2013 down to where it was in 2019 more or less repeats. That is to say, not all of that comes out, but some of it does. And when it does, it'll likely pursue assets rather than goods and services. Go to the next chart, consumer price inflation. I put a 2.5 benchmark for you to see. I put various metrics in there. You can see that having all items is much more volatile, the green, because food and energy are always historically volatile. Services in the red, always less volatile. They're all running above 2.5%. Why? Because we systematically have shortfalls in the economy. And until those shortfalls of supply are taken care of, we're going to get inflation. However, you are going to get capacity adjusted. And go to the next. What you have going on is reduced capacity, meaning rebounded, but below potential demand, creating transitory price increases. And I'm not trying to get cute with the word transitory. Capacity will return. How do you know capacity will return? I'm 71 years old in almost every product. Over all those 71 years, capacity is more or less around balance. Long-term gaps don't persist. The odd thing is, I think I just saw the president say, inflation is our biggest problem right now. It's not. It's one of the best things happening in the economy, because what it is doing is sending loud and clear signals. We need additional capacity here. Bring it on. It's profitable. And anybody who at this point views inflation as the problem doesn't understand what's going on. What's happening is it is saying we need extra capacity. It is the market at work after having shut down the economy. And you cannot shut an economy down without long and large-term effects in unanticipated ways. And this is not to say we should or shouldn't have shut down the economy, but what we're living through with inflation is just one more element of the cost of inflation, just like part of the cost of of the COVID. One of the costs of COVID is the amount that children didn't learn in schools while schools were going virtual. Another is the enjoyment people miss by traveling. Another is not being able to say goodbye to your loved one because you're unable to come in contact with them. Inflation is just one more of those costs. But the actual inflation itself is good in that it's sending signals. Go to the next chart. How quickly this changes. When we did this chart, I think 2 weeks ago, we were up year over year. As we sit here today, this chart is completely outdated because of the recent rundown in the stock market. The interesting thing is that we are basically, after the declines in the stock market that have occurred over the last month or quarter, we're basically back to where we were a year ago. And we need to get this chart updated. We're back to where we were a year ago. And if I said to you a year ago, did you feel pretty good about where you were at? I think you'd say yes. And so, and if I'd asked you a year ago, where do you think stock prices will be a year later? You'd have said anywhere from up 10% to down 10%. Well, turns out you were kind of right, namely they're flat. So it's not as big a catastrophe as you might think. You've got to have some perspective. Go to the next chart, commercial and industrial loans, lines of credit primarily by commercial banks. The red is the historic average as a percent of real GDP. You can see that it's still above average. The QE injections have kept it from going below normal. It has kept liquidity in the system. Banks are not being aggressive lenders. That's why they have all those excess reserves currently. On the other hand, it did not fall apart. And you see some earlier times where it really collapsed and to great detriment of the economy collapsed. It's still holding okay. Go to the next, just to give you a sense. Exports of goods in the blue have rebounded, but not fully, because overseas incomes have not rebounded fully, so they aren't buying as much as they were previous. And you see the red is services. Services are really down, and a huge part of that services in particular is travel by Chinese to the U.S., which are down. Coming back, not from China, but it's one of the weakest and oddest sectors of the economy. And just to give you an idea, I mentioned how exports are kind of oddly measured. Foreigners' hotel rooms in the U.S. are considered non-good exports. So there's a lot of oddities in that sector. Go to the next, the real crude oil price that is adjusted for inflation. We put a high marker, a low marker, and an average in. Highly volatile, like highly volatile. One of the interesting things is if you go back and read, every time it's near a high, the newspaper articles are saying it'll never go down. And then what you quickly see as it goes down, because those high prices sent signals. Those signals were it's highly profitable. That brought on more supply and reduced prices accordingly. Interesting on this chart, go back 2 years ago, literally 2 years ago, or at the end of April 2020. People forget the price of oil was $20 a barrel. The break-even extraction for fracking, which is the marginal source of oil in the world, was $30, $35 a barrel. They stopped fracking and they shut down wells. There were something like 400 wells active in the Permian at the pre-COVID, and we got to a low of I think 88 in the Permian operating. We're back up to some number around 340. so not fully back. You keep hearing producers say, well, we can't ramp up production, but they've ramped up production quite dramatically. It is not fully recovered production, but it will get recovered. Why? Because if the marginal extended price break-even point is $30 to $35 a barrel, and you can get above $60, $65 a barrel, you're going to extract. And as you do, supply will increase and things balance. Go to the next chart real quick. My assessment of the war, the Ukrainian war, on the U.S. economy. We don't have a lot of direct activity with the Ukraine or Russia, so there's little direct effect. Then you figure there's three things that we're quite good at, that because of the Ukrainian situation, more will be needed from us. First, defense spending. We're good at defense and defense systems, and Europe is going to be doing a lot, and probably Taiwan as well, will be doing more defense spending. We'll get a decent share of that, and that's going to be 15 to 20 basis points of GDP added. Next, Europe will be shifting its oil and natural gas consumption away from Russia. Not overnight, but they will. And again, not so much happened yet. We are the largest provider of oil and the third largest provider of natural gas. We'll probably end up the second largest provider of natural gas at these prices. Fracking will do quite well with this, as will non-fracking. But we're going to benefit from that shift, and we're already benefiting from the higher oil prices. So Denver, Houston, Dallas, Pittsburgh, because of the fracking effect, will do quite well. By the way, on the defense spending point above, wherever there's high concentrations of military systems or defense systems will do well. And then third, you've got the first and third exporters of major agricultural products at war, and that's obviously dampening that. They primarily export to eastern part of Europe, Central Asia, a bit to India, but notably to Africa. Those countries are going to look elsewhere to get their supply, and the U.S. is really good at agriculture. So you could imagine, if you're an Iowa farmer, this is going to be a good next few years. So overall, as these things take hold, and they're only in the early phases of taking hold, the U.S. is going to gain about 40 to 65 basis points of GDP a year from this. And then, Bruce, let me do real quick through the property sectors. I'm going to show real office rents, national level. You're going to see high, low, and average. So go to the chart that says real office rents per square foot. You can see the red is the average. We are below average. We're way off peak. Having said that, we're above trough, but it's not so pretty. And there are probably going to be more declines here, because until everybody gets back to work, which I believe they will, we can talk about that if you'd like in the Q&A as to why I believe that. But the office sector is showing weakness. Do the same thing on the next chart for industrial rents. Interesting how quickly we forget. A decade ago, industrial rents were at their all-time low in real terms. Today, they're at their all-time high. Do I expect that they'll moderate? Yeah, I expect they'll moderate, but there's a fundamental shortfall of supply because online sales uses a lot more space than brick sales in terms of their warehouse requirements, and therefore there's been a lag as online has increased. Go to the next. You see hotel real RevPAR way off its high. which it had been at for about 4 years, and way off of its high, and set a new low, set a real new low by a good margin, as you can see, set a new low. It's kind of almost back to average. All signs are the sector will have a very good summer. The exception will probably be convention hotels, and also the exception would be things that relied heavily on Chinese tourists, because China is still shut down and tourists are not coming. Go to the next. Real retail rents per square foot on a national basis. You can see the high, way off the high, above the low set shortly after the financial crisis. But they are below norm, not by a stunning amount, but below norm. Much as we expected, by the way, online sales, which skyrocketed in the first half of 2020 as the pandemic took hold, have flatlined. So the percent of sales that are occurring online has gone down. It is heading back to trend. It'll be back on trend, which is a rising trend, mid to late next year. You've seen brick sales go up in real terms to near record highs, bouncing around record highs, while online sales are flat to declining. And it's not because people don't like online anymore, it's that they got everything they would have normally got, and there are things that don't work online. And that's what you're up against there. Multifamily, next slide, real multifamily rents, high, probably have tapered just a little over the last couple of months, but still very high by real terms. And in fact, remember, these are real. So you could have rents rising and real rents falling because they're not rising as fast as inflation. And that's a little bit what's going on. But market for multifamily in pretty good shape. Things looking good moving forward. Supply under pretty good control. Housing is a fundamentally underproduced sector. And then real quick, the last slide, there are some big questions. What are they? How high will inflation go and for how long? I think we're about at the end of the real high numbers. Remember, when you start doing year-over-year comparisons, you're soon going to be comparing the periods where prices had already shot up as demand came back faster than supply. Until probably the summer, we've been comparing situations where prices had collapsed. And so that mechanically will lead to lower inflation. And the other thing is capacity is coming on. And as I told you, 400,000 people came back to work last month. 3% of GDP, 3% of industrial output came back. We're getting more capacity. How much regulation will return? We're seeing quite a bit. We're not going to see statutorily introduced regulation, but you're seeing it all around the edges. And that's a damper on growth. And the way I always view it is the regulation may be good or it may be bad, but in either case, it takes money and resources away from producing to lobbying and compliance. So the increase in regulation will certainly slow growth. Will taxes rise? Democrats are approaching a moment of truth where they abandon a lot of the more dream lists they had and focus probably on raising the highest marginal tax rate by a couple hundred basis points, raising the capital gains rate by a couple of hundred basis points. They've really only got a few months left to do that in, because if the by-elections go the way everyone thinks, they won't be able to get anything passed. And so my gut is yes, but marginally. And to the extent taxes are higher, we've had good growth during such tax rates. Not to say the higher taxes cause growth. It's more to say those higher taxes didn't kill growth, and they won't do it again. People will come back to work at the office, particularly in the tech sectors. People are turning over about 18% of the workforce each year. It's hard to create and maintain culture in such an environment. That means in 2 or 3 years, a lot of firms have got 60% new employees. How do you create culture that way? Another variant of it is, how do you reinvent the company if you've never met the people who comprise the company? And that's why I think tech in particular has got to come back to the office. Last, what happens in the November elections? I'm not a pundit. That said, it would be shocking if the Republicans don't take both the House by a small margin and the Senate by a comfortable margin, not a supermajority margin. And that would say that we are in a gridlock position again. I always find it funny that if somebody, whoever's in power, always views a split power structure as somehow unfair because they can't implement their agenda. And you go, well, that's the way the system works. It's not new. It is the rules of the game. So with that, Bruce, let me pause and take a couple questions before we wrap up at 2.
Okay, great. Thank you so much. Well, it's clear from the questions that have come in from the group, and by the way, feel free to keep sending your questions in, that people have 3 main things on the brain: interest rates, cap rates, and inflation. So I'll say, let's start with interest rates and talk about that a little bit more. Where do you think we're going to be in terms of the Fed funds rate by the end of the year?
I think who knows? The Fed has been a terrible predictor of themselves. Interestingly, the Fed has been one of the worst predictors of themselves for years. Having said that, I would think we're going to be at 2 to 2.5% Fed funds by the end of the year or very early next year. That would still be a negative real rate, even as inflation moderates. It would still be a low short-term rate by any historic standard. It would be getting some money back to grandma on her CDs, though, which would help intergenerational transfers. I think the long rate would then be somewhere 3 to 3.7%. And again, what I see is you're back to sort of 2019-ish environment.
On to cap rates. A lot of multifamily folks on the line today. Where do you see generally multifamily cap rates going in the next 3 or 4 years?
Stable to maybe down very slightly, down 5-10%. The reason I see them down is there's so much money. Go back to that excess reserve chart. There's another variant you can do of that, which is we have about 4 trillion, 3.5 to 4 trillion excess cash by historic standards being held by households, and about 1 trillion in cash beyond norm being held by businesses. And you say that's going to eventually come out, and maybe not all of it, but some of it's going to come out and try to find a home and assets and bid up asset prices. I think that money is much more likely to come out chasing assets than goods. On the inflation side, the Fed increased M2, or the M2 increased by Fed efforts by about 6 trillion. And people get very concerned about that. However, of that 6 trillion, 5 of it basically we buried in our backyards. We just put it in checking accounts. We didn't do anything with that money. And I told you the Fed injected $2.5 trillion through QE Infinity, but that money is also basically just sat in banks. So the Fed created an enormous amount of money, but most of it hasn't come out, whether it's held by banks, by households, or corporations. I do think some of it will come out, and I do think as it comes out, it'll create inflation, but I think it'll create asset price inflation rather than goods and services. If it creates inflation for goods and services, it's much likelier to be for things like Disney and other such sorts of experiences that were delayed for a couple of years than it is broadly. We've kind of done our goods expenditure side. So I see inflation staying in that range, and I see cap rates then staying down. As I've written about in Linneman letter, I've spoken about, you don't find any real correlation between interest rates and cap rates, but you find enormous correlations between cap rates and the amount of money in the system. And we've got a lot of money in the system and more to come out. And that's why I have this perspective. People say, well, gee, if interest rates go up, let's say they go up to where they were in 2019. By the way, people got along just fine with where apartment owners got along just fine. You say, well, if they go back to that, wouldn't you then have the people can't borrow as much? Well, yeah, they wouldn't borrow as much, but the weighted cost of capital wouldn't change much. And that's because as you borrow less, you're taking on more equity. And equity is more expensive than debt, but equity costs would be falling as you injected more equity because the equity isn't at risk as much. And therefore, the weighted cost of capital really wouldn't change much as the interest rate went up. The more important thing is not what the interest rate is money flowing into or out of real estate. And over the next years, I think it's going to be flowing in disproportionately and keep cap rates. And we've seen a number of times where interest rates rose, including in 2019, where interest rates rose and cap rates stayed the same or fell. Wasn't cause and effect. The point is there is no cause and effect. So I feel pretty good about cap rates, even though returns on equity will go down. And that's a separate issue. The return of equity going down is a separate issue from the cap rate going down.
We've had several folks inquiring about the continued attractiveness of the U.S. as a global investment destination. I remember hearing you speak probably 10 years ago at this point, and you said in no other country in the world can you lose money in real estate with as much documentation as you can in the U.S.
Right, right. Well, whenever somebody asks, I get asked a lot that question about what do you think of the U.S. and holding its position and so forth. And I always have the same reaction, which is, and where else do you suggest I go? Russia? How about Russia? You want to take your money out of the U.S. and go to Russia or Ukraine or Taiwan or China? Or, we're running out of Egypt. I was just in Egypt, and Egypt's exchange rate fell 20% in our first 2 days there. And that's because food prices were going up, and food is such a large part of their budget. And you want to go to Egypt? Before you say the U.S. will get weaker, you got to say, where will you go? And I don't know anywhere other than the U.S. to go. You want to go to Europe? You want to go to Germany, where they're going to be spending a lot more money on defense and energy? And by the way, if between now and when those transformations occur, Russia decides to turn it off, you freeze this winter, yeah, let's go to Germany then. That sounds good, especially given they're going to shut down two of their there are only 2 remaining, I think it's 2 nuclear facilities, and become even more dependent on Russian natural gas. So I'm not trying to be cute, but when people ask that question, you sort of go, well, yeah, where else? It's almost like saying, gee, Michael Jordan or LeBron James or Kareem Jabbar or somebody missed some shots. We ought to get rid of the bum. And you go, well, okay, they did miss a couple of shots, and we may even have lost a game or 2 because of it, but who's going to take their place and be better? And that's our situation. Who's going to take their place and be better? And the answer is, I don't know of anybody. You know, if you've got, imagine a team of LeBron James and Oscar Robertson and Kareem Jabbar and Michael Jordan and who else do you want to put on that team? If one of them misses a shot, exactly who am I going to replace them with that's a lot better? Certainly not, I mean, I like you, Bruce, but certainly not with you and certainly not with me.
Let's wrap up with one last question. Do you have any favorite markets geographically within the U.S., or perhaps look at it as, what do you think the areas in the U.S. are going to have the strongest economic growth, strongest population growth in the near term?
Yeah, I don't think there's been huge changes in that. The so-called Sun Belt will continue to have a lot of growth, some of it natural, in that they're a little younger and therefore have a little higher natural birth rate. Some of it from immigration geographically, whether it's Florida or Texas, Arizona. I think that will continue. The thing I wrote about in the last Linneman letter is it's all fine and well to have a lot of growth in demand, but especially if you're a developer. If you're a developer, you just want growth in demand. You want population growth, local economic growth, you get fees and so forth. But if you're an owner, you care about the balance of demand and supply. So you can have great growth, but if supply constantly outstrips, developers do well, but owners don't do so spectacular. Right now, I would be looking at high beta markets. And in Linneman letter, we go through high alpha, high beta markets. I believe the U.S. economy is going to do quite well the next several years. I think we've gotten ourselves frightened in the last couple of months we're seeing ghosts. It reminds me of what's happened in the last couple of months. Remember, we're just little animals. We're just a little species that have evolved trying to survive. We have all these survival reactions. And it reminds me what's going on now is when every once in a while I'll be walking home at night, perfectly safe, and I hear something behind me, and I look over my shoulder and I don't see anything, or I hear a rustle in the bushes, and then I pick up my pace going, oh my God, what if there's somebody there who's going to rob me? And then I walk faster, and then I walk faster and faster, and I keep looking over my shoulder, getting more and more frightened over probably a squirrel that rattled in the bushes, right? I think that's what's going on, and we're getting ourselves frightened, and we do this from time to time. It's kind of how the species survives, I suppose, but it doesn't make it rational at the moment, even though it's rational in a survival sense. And I think we're seeing ghosts. I think we're seeing, of course, there's a million problems with the U.S. economy. There are always a million problems with the U.S. economy. And the amazing thing is we continually figure out how to overcome them and grow. So, yeah, I would bet on high beta markets, but mainly because I think that this is places that outgrow the U.S. when the U.S. grows are good places to be, because I think we're in for a good stint of growth.
Well, thanks very much. We did have a couple people chiming in with some fifth man or sixth man off the bench. One person said you forgot forgot Larry Bird. So
Larry Bird would be a perfect Larry Bird. But even if we put Larry Bird as our next person, they're still going to miss the shot. And people are going to say, what a bum. I'll end on this note, besides thanking you, Bruce, and thanking everybody. I lived in Philadelphia, and I got to see Mike Schmidt. Mike Schmidt probably was the best third baseman, arguably, in the history of baseball. He was a really good defensive player. He was a really good power hitter, and he hit for good average, and he's in the Hall of Fame for good reason. And I saw year after year after year, people just boo Schmidt. Even as he's being the best third baseman year after year, they would just boo him. And I'm going like, well, okay, he did, pop out, or he didn't hit a home run when you wanted him to, but who exactly do you want instead of him, right? So
Right.
That's the U.S. Who exactly do you want instead of him?
Well said, as always. So thank you so much, Peter. Unfortunately, we're not going to be able to get to any of the other questions that came in, but I want to make everyone aware that this presentation is very much just a digest of what's presented in far greater detail in the Linneman letter, which is a quarterly hard copy subscription from Linneman Associates. You can find out more information on the publication and more about Linneman Associates at linnemanassociates.com, and more about REFM at getrefm.com. As a reminder, if you're registered, you will automatically receive an email link to the recording of this webinar in about an hour. So thank you again, Peter, and thank you to everyone for joining and participating, and we hope to see you back in the summer, and stay safe.
Thank you.